Welcome to Breaking News to Trading Moves. Welcome to the debate. When we look at modern aviation, there is this expectation of mechanical reliability.
Oh, absolutely.
You set the coordinates, you engage the autopilot, and the plane essentially flies itself. It is a straight mathematical line from point A to point B.
Right. Well, assuming the weather holds, right, and the atmospheric pressure remains perfectly stable. But as we know, the atmosphere rarely cooperates for very long.
Exactly. And when we step into the financial market, suddenly that autopilot mechanism looks incredibly vulnerable. The coordinates for wealth creation might be clear, but the atmospheric pressure is intensely volatile.
Very true.
So today, we are connecting the dots across multiple financial studies to debate a central question. Is a static buy and hold portfolio structurally flawed in our current financial climate? Or is tactical market timing just a mathematically inferior approach?
And I think it's crucial to lay out exactly where we stand here.
Right. I take the position that a highly disciplined, long-horizon allocation strategy remains the most robust path to wealth creation, provided, of course, that it relies on enduring business metrics rather than, lazy complacency.
And I represent the view that active risk management, specifically through tactical allocation and trend following, is entirely necessary to preserve capital. We have to defend against our own behavioral biases and, frankly, the harsh macroeconomic realities we are facing right now.
Okay, so I want to start by establishing the mathematical headwinds of tactical timing, because attempting to jump in and out of the market routinely degrades returns, and we really do have the data to prove it.
Well, you have to look at the specifics, though.
We did. AQR Capital Management conducted this very extensive test of 196 distinct buy-the-dip combinations from 1965 to 2025.
Okay, that is an extensive timeline to cover.
It is extremely comprehensive. And they didn't just look at one metric. They tested various severity levels of market drops, different durations for those drops, and holding periods ranging anywhere from 1 month to 5 years.
All right, and the results?
The average Sharpe ratio for these timing strategies actually dropped by 0.04 compared to a passive equity allocation.
Which is a meaningful drag on performance.
It is. And, for anyone listening, the Sharpe ratio is essentially a measure of how much extra return you are getting for the stomach-churning volatility you are enduring.
Right, risk-adjusted returns.
Exactly. A lower number means you are taking on more risk for less reward. Out of all those 196 variations they tested, a mere 8% showed statistical alpha.
Meaning they beat the market.
Right, meaning they actually beat the market through skill or strategy rather than just riding the general upward drift.
But we have to ask why they were jumping in and out to begin with.
The logic behind why timing fails is actually pretty straightforward. The equity risk premium rewards investors for bearing risk over a long timeline.
Right, that's the compensation.
Yes, when you pull money out of the market to avoid a drop, you systematically deprive your portfolio of the long-term compound growth inherent to equities.
But only if you stay out too long.
Sure, but the analysis from the street reinforces this exact concept. True long-term investing requires continuous due diligence and a tolerance for near-term volatility.
It's not just blind holding.
No, it requires finding companies with hard catalysts, like a new product cycle or change in management, and waiting for the thesis to play out. It isn't passive in thought, but it must be patient in action.
I come at it from a very different angle. That perspective relies on an idealized version of human psychology that frankly just does not exist in the real world.
Oh, you think buy and hold is idealized?
Absolutely. The concept of buy and hold is frequently marketed as a universal set-it-and-forget-it solution. But the analysis from Financial Mentor highlights a critical structural contradiction in that advice.
What contradiction?
We are told to buy and hold passive indexes like the S&P 500, right? Yet those very indexes are dynamically managed. They drop failing companies and add successful ones.
Well, that is the benefit of the index, though. It cleans itself.
True. So the benchmark itself is tactical, while the individual investor is told to sit on their hands and remain static. But the broader problem is human behavior.
Meaning we get in our own way.
Data from Financial Tortoise shows exactly why human psychology inevitably derails these static strategies. Normal human beings are not fully rational. We suffer from overconfidence, believing we have an illusion of control over market outcomes.
The illusion of control.
Yes, They reference a fascinating study where test subjects were asked to keep a ball in the upper half of a screen using a controller.
Okay.
The subjects were absolutely convinced they had control over the ball. They were explaining their strategies and movements even when the device was completely disconnected from the computer.
Wait, so the ball was just moving randomly?
Completely randomly. And we apply that exact same illusion of control to the stock market because, we constantly get in our own way through herd mentality and overconfidence.
Right.
So a static strategy just lacks the necessary mathematical defense mechanism. Tactical asset allocation, based on unemotional economic indicators, acts as that defense. It removes the human error from the equation.
That's a compelling point. The behavioral challenges are absolutely real, and I won't pretend investors don't sabotage themselves.
They do it all the time.
They do. But the solution to bad behavior isn't introducing a strategy that forces you to fight the prevailing market momentum. So let's look at the macroeconomic environment, because that is probably the most common justification people use for attempting to time the market.
The classic, the economy is doing X, so I must do Y.
Exactly.
Okay, let's explore that macro environment. Because the data from Confluence Investment Management shows exactly why a static allocation is structurally flawed right now. We're dealing with the socialization of private debt.
Okay, elaborate on that.
Well, following the 2008 Great Financial Crisis and subsequent systemic events like the pandemic, the Federal Reserve expanded its balance sheet past $6 trillion. And they didn't just buy treasury bonds.
Right, they bought a bit of everything.
Exactly. They broadened their support to include corporate credit, municipal debt, commercial paper.
They effectively became the buyer of last resort for the entire private sector.
Yes. And when private sector debt becomes unsustainable, the government absorbs it onto the public balance sheet. But that action has consequences.
Meaning inflation.
The mechanism here leads to a prolonged period of financial repression. The government has to service that massive debt, which historically manifests as rising long-term interest rates and gradual inflation, much like we saw in the post-World War II period.
They inflate the debt away.
Exactly. Given this rare macroeconomic backdrop, the blind indexing that worked for the past 4 decades is mathematically unlikely to work for the next 4. The plumbing of the economy is totally different.
So you're saying we need defensive strategies?
We do. We need bond ladders utilizing corporate and treasury ETFs to deal with rising rates, and we need precise allocations to precious metals to hedge against inflation. A static 60-40 portfolio simply ignores this reality.
I see why you think that, but let me give you a different perspective. Because making dramatic portfolio changes based on macroeconomic predictions introduces an unacceptable level of shortfall risk.
How so?
The TIAA endowment study provides a rigorous multi-period Monte Carlo simulation analyzing this exact trade-off.
Running thousands of randomized lifetime scenarios to see what breaks.
Precisely. They looked at the delicate balance between short-term drawdown risk, which is painful but temporary, and long-term shortfall risk, which means actually running out of money.
The ultimate fear for retirees.
Exactly. If you abandon equities out of fear of this financial repression you're talking about, and you adopt a conservative allocation, let's say 10% equity, 80% bonds, and 10% real assets.
You certainly lower your short-term drawdown risk with that.
You do. You won't see severe swings. But the TIAA simulation shows you simultaneously incur a nearly 70% chance of losing real value over a 10-year horizon, assuming a standard 5% payout rate.
Wait, a 70% chance?
Yes, because inflation outpaces the conservative yield. If you are taking out 5% and inflation is eating another 3%, your conservative bonds yielding 4% are mathematically bleeding you dry.
I see the math on that.
For long-term investors aiming to maintain purchasing power, that level of shortfall risk is ruinous. Instead of abandoning equity exposure based on Fed balance sheet predictions, a 60-30-10 mix of equities, bonds, and real assets strikes the optimal balance.
So remaining mostly in equities.
Right. It navigates the short-term drawdown while protecting the portfolio's real value without ever requiring you to tactically time the market based on macro forecasts.
I'm sorry, but I just don't buy that. Let me tell you why. The TIAA model focuses heavily on long-term shortfall risk, but it vastly underestimates the immediate severe impact of sequence risk, especially for investors who are relying on their portfolios for income.
sequence of returns risk.
Right. The analysis from the Chartered Institute for Securities and Investment outlines this perfectly. Sequence risk is the danger of getting a cluster of bad returns right when you start taking money out of your account.
Which breaks the compounding.
It is like digging a hole while you're trying to build a ladder. If you take out 5% a year to live on, while the market drops 30%, you are forced to sell twice as many shares just to survive. The math of compounding entirely breaks.
But that assumes a prolonged, devastating drop right at the exact point of retirement.
Which happens more often than people think. If you look at the quarterly returns of the FTSE 100 over a 17-year period, you rarely see isolated small positive returns interspersed with small negative ones.
You see them grouped.
You see clustered periods of severe negative returns, like the crash in 2000 or the meltdown in 2008. If you experience a severe drawdown while withdrawing capital, your portfolio sustains heavy damage.
Because you lock in the losses.
Yes, you sell shares at depressed prices, permanently destroying your capital base. The recovery never matters because you don't have enough shares left to capture the upside.
So what's the structural solution?
This is where Kaz Business School research offers a clear mathematical solution: trend following. By applying simple, monthly trend-following techniques, you move the portfolio to cash during negative trends. It is a purely mechanical, unemotional process.
Moving to cash to avoid the sequence risk.
Exactly. It preserves the capital base, so it actually exists when the recovery begins.
I'm just not convinced by that line of reasoning. Because, relying purely on trend following it's like relying on a fire alarm that only rings after the building is half burned down.
Wait, how so?
Well, think about the mechanical reality of a trend-following system. It actually requires time for a downward trend to establish itself before the model triggers the sell signal.
Right. It needs the data to form a trend.
Exactly. And the AQR data demonstrates this vulnerability very clearly during the February and March 2020 market crash. Trend following severely underperformed its historical averages because the decline was simply too rapid for the mathematical trends to develop.
They got whipsawed.
Completely whipsawed. The market dropped over 30% in a matter of weeks, and the trend following models did not exit until the very bottom, right before the sharp rebound began.
So the mechanical system locked in the losses.
Exactly. Rather than mechanically selling equities at a loss during sudden drawdowns, the CISI study you referenced earlier actually details a far superior, non-tactical solution. They call it the bucket approach.
But the bucket approach still requires holding dead capital in cash, doesn't it?
It requires holding capital with a specific structural purpose. It's about asset location, not market timing. By isolating a highly liquid cash buffer in bucket 1 to cover 1 to 2 years of near-term living expenses, you completely neutralize that sequence risk we just talked about.
Because you don't sell equities during the crash.
Precisely. You draw from the cash buffer. This allows your intermediate fixed income assets in bucket 2 to generate yield and your long-term equity holdings in bucket 3 to ride out the volatility. You solve the sequence risk problem structurally.
Without timing the market.
Right. Without attempting to time market trends that often move much faster than the models can react.
That's a fair criticism regarding the speed of modern drawdowns. High-frequency trading and algorithmic selling have definitely accelerated market drops. But have you considered the opportunity cost of that bucket approach?
Holding the cash.
Yeah, holding 1 to 2 years of living expenses in cash that yields barely enough to pace inflation creates a substantial drag on overall portfolio performance over long periods.
It's the price of structural safety.
But we have better mathematical tools now that don't require holding cash for years. The models have advanced beyond simple moving averages. Let's look at empirical, long-term testing of tactical indicators.
Okay, what kind of indicators?
The researchers at Laurentian University conducted an exhaustive 30-year backtest using very specific, unemotional mathematical indicators to govern asset allocation. They didn't rely on subjective feelings about the market.
So, purely quantitative.
Totally. They used the yield curve spread and the standard deviation of the S&P 500.
Okay, so they were looking at credit markets and equity volatility.
Precisely. They looked at the spread between 90-day T-bills and 10-year bonds. When short-term borrowing costs more than long-term lending, an inverted yield curve, It chokes the credit markets because banks stop lending.
It is a structural breakdown in the plumbing.
Right. And when that spread hit negative 0.25, or when the S&P 500 monthly standard deviation jumped 2.5 times above its historical average, the strategy systematically moved 50% of its equity allocation into bonds.
Moving half the portfolio based on just 2 metrics. That's aggressive.
Yes, and the results were absolute. Over a 30-year span, this tactical strategy improved risk-adjusted returns and lowered portfolio variance 100% of the time compared to a passive holding strategy.
Wait, 100% of the time?
Every single time. They ran 81 different test observations, and it worked across the board. When the indicators signaled extreme danger, the system moved to safety. It increased the Sharpe ratio universally.
Interesting.
That is not a behavioral flaw, that is rigorous quantitative risk management. They even found that increasing the asset allocation change to 100% during these specific trigger events produced the highest return.
Moving entirely to bonds.
Yes. It mathematically proves that static portfolios carry uncompensated risk during periods of high variance or inverted yield curves. It addresses the reality of utility theory. Losing money hurts our standard of living far more than gaining excess returns improves it.
The Laurentian study provides robust back-tested data, I'll grant you that. But we must look at the broader mechanics of what tactical timing is actually doing to a portfolio structure.
In what sense?
Well, when you employ these market timing strategies, you are essentially acting as a value investor operating in a momentum horizon,
Meaning what exactly?
meaning your time frames are clashing. AQR points out this exact contradiction. Most trends in financial markets play out over weeks or months, while value reversions, where an asset returns to its intrinsic price, take years.
So you're fighting the trend?
By trying to buy dips or exit on volatility spikes, you end up fighting the prevailing momentum of the market. However, I will concede one thing.
Oh.
Momentum, as an isolated factor, is undeniably powerful. The SG Trend Index, which tracks the largest trend-following funds, has historically produced an annualized 4.7% alpha to equities since the year 2000.
Exactly. Trend following works mathematically over long durations. It delivers outperformance during major drawdowns because of its convex payoff profile. It acts like insurance that pays out disproportionately well exactly when everything else is crashing.
But here is the critical mechanism. You don't actually have to choose between static indexing and total tactical reallocation.
You're saying it isn't binary?
Right? It isn't a binary choice where you either hold forever or sell 50% of your assets. AQR proposes a superior structural solution called Portable Alpha Trend.
Well, portable alpha usually involves leverage, doesn't it?
It does, but let's explain how it works. Rather than moving half of your portfolio out of equities and sacrificing your baseline equity risk premium, you maintain your standard global 60-40 exposure.
Okay, so you keep the core intact.
Exactly. Think of it like a pie chart. You keep the slices exactly the same. Then you apply a 20% trend-following overlay on top of that portfolio using derivatives or margin.
I see.
You combine the consistent beta of steady market exposure with the alpha of trend following. In their testing, this portable alpha approach achieved an average excess return of 5.0% compared to the 4.2% of a standard 60-40.
While preserving the structural integrity of the portfolio.
Precisely. It is an additive process rather than a disruptive one. You capture the alpha of the trend without ever timing your core holdings.
I hear the mathematics of the portable alpha model, and the back-tested returns look highly appealing. But have you considered the structural fragility you just introduced?
The leverage.
Adding a 20% overlay on top of a fully invested portfolio requires borrowing. That introduces financing costs, margin requirements, and counterparty risks.
It adds complexity, yes.
In a severe liquidity crisis, when credit dries up, the cost of maintaining that leverage can completely erode the alpha you're trying to capture.
But the models account for friction.
But they often underestimate panic. The beauty of the Laurentian tactical allocation model is its absolute simplicity. It requires no leverage.
It just moves capital.
It simply moves existing capital from high-risk assets to low-risk assets when mathematically proven danger signals flash. It acknowledges that human beings will panic during an extended bear market, and it provides a rules-based framework to protect them from themselves.
Financing costs are absolutely a factor, but the AQR model specifically deducts an assumed financing cost of 0.50% per year to account for that reality.
Which cuts into the alpha.
It does, but even with that deduction, the risk-adjusted returns remain superior. The danger of the Laurentian model, moving 50% or even 100% of your assets to bonds, is that you must be right twice.
Exit and entry.
Exactly. You must be right when you exit the market, and you must be exactly right when you decide to re-enter. History is littered with investors who accurately predicted a market decline, moved bonds, and then entirely missed the subsequent multi-year bull market because their mathematical indicators didn't signal an all clear fast enough.
It is a risk.
If you miss the recovery, your capital is permanently impaired against inflation. Furthermore, the street analysis reminds us of, well, the qualitative aspect of investing.
The fundamental thesis behind the numbers.
Right. Sometimes a company's stock drops rapidly because management is investing heavily in the business. Maybe they are transitioning from upfront software sales to a subscription model.
Which causes a near-term pause in revenue growth.
Exactly.
The quantitative tactical models will see that volatility, they'll flag it as variance, and signal a sell. Meanwhile, the diligent buy-and-hold investor recognizes the catalyst, understands the mechanism of the transition, and just holds for the long-term secular growth.
And history is equally littered with buy-and-hold investors who rode their portfolios down 50% and capitulated at the exact bottom because the psychological pain became unbearable.
Fair point.
The mechanical indicators remove the need to be right emotionally. They execute the re-entry automatically when the trend turns positive, completely removing the human element that causes us to eat that third Twinkie, to borrow the financial tortoise metaphor, even when we know it's terrible for us.
We lack discipline.
We do. We need guardrails because we cannot trust our own judgment during periods of extreme financial stress. Which really brings us to the core tension of our discussion. From my perspective, the math consistently shows that staying invested captures the enduring equity premium.
Assuming you don't panic.
Right, provided an investor maintains structural liquidity buffers, like that bucket approach we discussed. They can weather sudden market corrections without the need to panic sell, thereby allowing long-term compounding to work unhindered by transaction costs or timing errors.
And from my view, strict mathematical, tactical indicators and trend following are essential tools. They combat inherent human behavioral flaws and protect against prolonged market downturns caused by structural macroeconomic imbalances.
A defense mechanism.
A static portfolio without a defensive mechanism is dangerously exposed to sequence risk and human panic.
Yet, while we disagree on the necessity of actively timing market entries and exits, we completely agree on one overarching principle.
That blindly holding an unexamined portfolio without a clear risk management framework is a guaranteed path to failure.
Absolutely.
Whether that framework involves a strict cash buffer or a quantitative trend-following rule, hope is just not an investment strategy. You must have a mathematically sound defense.
We encourage everyone listening to connect the dots within your own financial plans. There are numerous structural approaches left to explore in the data we discussed today.
The mechanics of your portfolio require your attention, not your passivity.
Indeed. Returning to our aviation metaphor from the beginning, whether you trust the autopilot to fly through the storm or you believe the pilot must take the yoke when the atmospheric pressure drops, the worst possible outcome is falling asleep in the cockpit. Thank you for listening. Keep analyzing the coordinates.